Hi, and welcome back to Investment Banking University. This is our investment banking course, and we are on the second side of the perpetuity, which is the sell side. We're actually going into what is an investment banker and talking about the marketplace within investment banking associated with the middle market. The majority of perpetuities are in what is known as the middle market, a classification for mid-sized perpetuities. This is where the majority of transactions occur and where the average investment banker will make his living. So we are going to investigate a little bit about the middle market as well as the breakdown. So because of wide range of company sizes within this definition, the middle market can be broken down into the following. And so we're going to overview the middle market between the lower middle market, the middle market, and the upper middle market. So the platform which provides this data is called PitchBook, and PitchBook defines the middle market as companies with total enterprise value between 25 million and about 1 billion. And the core middle market is between 100 million and 500 million. So the lower middle market is from 5 to 50 million in revenue. And companies with EBITDA below about 10 million are at the lower middle market, and typically they're family or entrepreneur owned, and they have individual customers concentrated a bit more than they would do in, say, the middle market. And so many of these relationships are concentrated with the family or with high management. In terms of the middle market, this is between 50 and 500 million in revenue. And that we define the core middle market as companies with about 10 to 75 million in EBITDA. In terms of the upper middle market, we're talking about 500 million to about a billion in revenue, and the upper middle market typically has about 75 million and above in EBITDA, and these are often publicly held or sponsor backed. So now we're going to get into M&A multiples with a focus primarily on the middle market. So it's crucial for investment bankers to understand the M&A marketplace in the middle market, and particularly the industries that they cover. It's important for the investment banker to have a strong understanding of multiples in the M&A marketplace in general, and then in his or her sector and subsector. In general, in the middle market, we typically see about 7 to 7.5 times EBITDA for companies that are larger than 25 million in total enterprise value. For companies that are smaller than 25 million in total enterprise value, we typically see about 5 to 5.5 times EBITDA. And that's before we start getting into small businesses that are even smaller than the lower middle market. There are adjustments, of course, that need to be made for size and predictability of revenues, as well as for certain sectors, for example, software. So we're going to take a look at some charts that were actually pulled from PitchBook, the data provider. So since the investment banker will most likely be starting in the lower middle market or middle market, it's important to have a strong understanding of the multiples in the M&A marketplace in general, and then in your sector and subsector. The following are the 2016 M&A multiples from the data provider PitchBook, which was bought by Morningstar, that you can use initially just for understanding, and this is what we're going to help get an idea of what multiples should be looking like. Here are the EBITDA multiples for transactions in the lower middle market. So as you can see here, we're looking at a range of about 5 times to almost 7 times, moving from 2012 to about 2016. In the last quarter, or Q2 of this chart right here, we see an increase from about 5 to about 6 times EBITDA. On the next page, or the next chart we're going to be looking at, these are EBITDA multiples for transactions in the middle market. So we're looking at total enterprise value to EBITDA. And so these are buyout multiples from about 25 million to 250 million in enterprise value. So we're, of course, looking at from 2012 all the way to 2016. And as you can see on the low side in 2012, we have an EBITDA multiple of about 7. And moving up to 2016 in quarter 2, we're at about 8 times. On the next chart, we're looking at EBITDA multiples for transactions in the upper middle market. And as you can see, there's wide variability, especially in the third quarter of 2013. But we're typically going to see in the range of about 9 to about 12, and it's dipped down in Q2 of 2016. But you can see there that these are much larger EBITDA multiples that we're talking about in the upper middle market. And so we're going to notice how the multiples increase as the size of the perpetuity increases due to the scarcity of larger perpetuities, increased demand of large perpetuities, and less of them. This is a chart that's depicting the average debt to equity breakdown for LBOs. These are financial sponsors that are going to be purchasing perpetuities. And you will notice that equity levels are steadily increasing, indicating a tighter credit market. And what that ultimately means is there's less of a proportion of debt going to be used in LBOs, which means more equity is needed and a lower IRR. In this chart, you're going to see at the average time that it's taking for deals to close. And we have a range from about less than 5 weeks all the way to more than 20 weeks. So you're going to see the changes in that, and we'll get into that a little bit later in the course when we're talking about the M&A process and running the M&A process. So this chart actually depicts the percentage of deals that are getting done with some aspect of an earnout, meaning the portion of the purchase price is contingent on the future performance of the business. And we're going to see that in the range of about 30 to about 45%. And then in 2016, at the end of Q2, we're looking at about 40%. And then finally, this is a chart depicting the activity for buyers of perpetuities. And so we're taking a look at of those that received confidential information memorandums from investment bankers running an M&A process for a perpetuity, how many of those actually turned into an indication of interest, how many turned into management presentation attendance, how many turned into LOI, and then how many turned into an actual deal closed. And so respectively, we have 22%, 28%, 18%, and 12%. And that's it for this video. We're going to talk about the investment banking coverage methodology in the next video.